I mean, 23 is what we care about at this point, isn't it? We're in the second half of 22, and it's what I'm getting questions about, because is it going to be 240 in S&P earnings or 200?
Right.
It's a big difference.
Absolutely. All the portfolio managers and ourselves as well are focused on the outlook for next year. And the concern is you have about a 1% GDP growth in the next year, and that would be a headwind, generally speaking, for revenues. But the higher inflation is going to be a pressure on margins, and that is the bigger issue. And that's why, David, the level of forecasts for the consensus is probably too high. Our forecast is something on the vicinity of around 3%, as you indicated, about 3% earnings growth. That's pretty modest, and that's the idea that the S&P 500, therefore, at these levels, offers only maybe 4% upside from now through the end of the year. Relatively modest. However, as you indicated, if you had a recession, that would put the earnings down around 11%. That's, historically speaking, a little less of an earnings decline than is typically the case in a recession. Because if you had a scenario with a recession, it's not our baseline, but the idea would be a relatively more modest recession. You don't have some of the exacerbations or uncertainties around higher leverage balance sheets, some of the sort of unusual aspects of the last couple of downturns. So if one had that, you would see earnings, in our view, come down to around a decline of around 11%. And that would lead the S&P 500 down to around 3,150. So that'd be obviously a much lower level, not the baseline. The baseline is 4,300 at the end of this year, driven basically by modest earnings growth for next year.
Right. Although one would expect, and this goes back to the conversation Melissa and I were just having, that it's not the easiest time to predict what earnings are going to be. Companies themselves are having a very difficult time, given limited visibility and these so-called macroeconomic headwinds that we continue to hear about.
Well, we certainly have higher oil prices. Obviously, more recently came down, but our general view is oil prices are going higher. You have the inflation pressures. You have basically the Fed raising rates. So all these uncertainties. In fact, Dave, when you went through, as we did, the transcripts for all of the second quarter conference calls, we've just finished basically the second quarter earnings season, companies across the board were highlighting your view or your observation that there was a lack of clarity, a lot of cloudiness in terms of the prospects of their supply chain issues, some issues on the end demand, the consumer, some of the hiring challenges. So there's a lot of murkiness in the outlook. I think that's the best way to describe it. And so our general view is want to bias towards higher quality companies in a portfolio. Not a shocking concept, but the idea of stronger balance sheets. I think the other issue is on this margins. I think that is the critical issue as we look into the coming year. And there's so many companies where there has been a margin decline in the last quarter, yet the expectation is for margin expansion into calendar year 2023. I think that's where you're likely to get the biggest negative earnings revisions across the board. And I think that's a general theme for fund managers.
We've seen margin declines, but we've seen revenues grow modestly, and that's this whole notion of charging higher prices. And at some point, the consumer is going to balk at that, and I think they're starting to do that now. That's what we've heard from a company like Procter & Gamble, for instance. How do you think about the consumer and when the consumer feels the full impact of inflation? Because I feel like we're just starting to see that now. It's sort of a delayed impact, even though it looks like inflation has come down quite a bit.
So the idea of higher inflation is a generally good thing from a revenue point of view in terms of the nominal revenues that a company reports. But it is a big pressure on margins, as you indicated. So the consumer sentiment right now is around the lowest it's been in almost 60 years. So that is certainly one indication that sentiment is not great. When you look at the sort of disposable income at the different cohorts across the U.S. Economy, most of those areas, most of those cohorts are showing decline in disposable personal income. So that's a headwind, if you will, for spending ability and sort of the discretionary side of it. And that's generally a pressure. I think you see it on the end consumer demand for those products. Food prices are up a lot. Gasoline prices are up. These are basically headwinds that sort of go across the economic spectrum.
Shepard Smith here. Thanks for watching CNBC on YouTube.